Hello and welcome to ThePrint. I'm TCA Sharad Raghavan and I'm going to be talking to you about how the RBI is now grappling with an unusual problem. India's digital banking push and the overall accessibility of social media may have been too successful. That is, people are now too connected to their bank accounts and are too susceptible to social media rumors that often spread misinformation. The concern is that in times of a crisis at a particular financial institution or even a rumor of one, depositors can vacuum out their money too quickly for regulators to respond to. ThePrint has learnt that officials in the RBI have held at least 2 meetings so far and have issued guidelines to financial institutions to check their internal systems to reduce the time it would take for them to react to sudden widespread withdrawals. In addition, the RBI last week also issued a draft circular with guidelines to banks to maintain higher levels of buffer funds associated with deposits in accounts that are connected to internet banking, mobile banking, or even UPI. According to bank officials, this would include nearly all bank accounts now. One consequence of this heightened safety measure, however, is that it will reduce the funds available with banks for lending. As Sachin Chaturvedi, non-official director on the central board of the RBI, told ThePrint, the example of what happened to Credit Suisse in March 2023 is a case in point of just how quickly people can withdraw their money from an ailing bank. According to him, nearly all the deposits of Credit Suisse were taken out within just 6 hours. In the US, something similar happened with Silicon Valley Bank, where it took 12 hours for depositors to take nearly all of their money out. So, Chaturvedi explains, the discussions in the RBI were to gauge how much time it would take in India for such withdrawals to happen and how much time it would take to block and check these. The RBI is not the first to raise concerns about the highly connected nature of bank accounts and the increased speed of bank runs. Following the collapse of SVB, the US Federal Reserve conducted a review of its supervision and regulation of the bank. In its report, the Fed's Vice Chairman for Supervision highlighted the increased pace at which bank runs now take place. According to him, the combination of social media, a highly networked and concentrated depositor base, and technology may have fundamentally changed the speed of bank runs. In the SVB case, he said social media enabled depositors to instantly spread concerns about a bank run, and technology enabled immediate withdrawal of funds. According to Anil Gupta, Senior Vice President and Co-Group Head of Financial Sector Ratings at ICRA, there are a number of instances within India as well where the RBI has taken action against a bank and this has led to fear amongst depositors. He too said that social media plays a significant role in creating panic. Here's one example of how social media rumors can create such panic. In March 2023, when SVB collapsed, the Mumbai headquartered Shamrao Vittal Cooperative Bank, or SVC, had to quickly issue a clarification that it was completely unrelated to Silicon Valley Bank based in California. It had to do this because rumors were quickly spreading online that it was this cooperative bank that was in trouble when it was in no way connected to the banking troubles in the US. According to Chaturvedi, faith and trust are the two biggest casualties with the rise of social media, and the financial sector is one of the worst impacted since withdrawals can happen in seconds during off hours or office hours and through various digital modes. Last week, the RBI issued a draft circular in which it suggested that banks should set aside a higher amount as buffer for accounts connected via internet or mobile banking. The new rules are to come into effect from 1st April 2025. Basically, from that point, for every rupees 100 that banks have in accounts that are linked to internet, mobile banking or UPI, the bank has to set aside 10 to 15 rupees as a buffer. While the upside of this is of course that banks will be better prepared if at all there's a run on their deposits, the downside is that they'll have less money available for lending purposes. Now, bank lending funds not only investment but also consumption. So lower bank lending could potentially impact economic growth. This is the trade-off that regulators have to make and the problems being created by our increasingly digital landscape. But on that note, that's all from me. Thank you for watching.